a call option versus a put option, probably an understanding of American options versus European options. So we'll spend some time in terms of understanding the different types of options. And what do I mean by the positions? What are the different kinds of positions that are there in options, the long and the short positions? How do I typically interpret each of these positions with respect to the options? Then, what are all the various underlying assets on which the options are typically traded today? And what are the key elements that go as a part of the option, the specifications? What do I mean by the expiration date? What do I mean by the strike price? So the various specifications that are associated with the options, and more or less talking about just a brief idea into the trading activity associated with the options. And I would just touch base upon the commissions that are typically associated, the costs and the commissions that are associated with respect to option. And one more important point, as we have discussed even in futures, how margins are typically playing a role with respect to the option. So these are the different dimensions that I would like to cover, and towards the end I'll spend some time in terms of understanding the different applications of option. So where I would focus, just give you an overview of how warrants or probably employee stock options, ESOPs, convertible bond, they are also some kind of variants of the options themselves. So this is what is a typical thing that we are going to look at as a part of this particular session. All right. So to get started, the first thing I will be focusing on is an understanding of the different types of options. We know that there are two major types of options: one, a call option, and two, put option. So whosoever has taken the call option, for that particular person, we are talking about right to buy. Whosoever has taken an option, he is having a right to buy an asset in future. If he wants, he can buy. It's a right. It's his right to buy the asset in future, whatever the date, within a particular date, and a price, which are typically decided upon today itself. Right, on the day of entry into the option contract itself, these two are agreed upon. Whereas when we are talking about a put option, the person whosoever has taken the put option, he has the right to sell the asset. If he wants, he can sell the asset. If he does not want, he cannot. He can very well not sell the asset also. But if at all he wants to sell, the date as well as the price at which the selling can happen are decided at the time of entry into the contract itself. So here the person who has taken the option is called as the holder of the option, or we generally call as the buyer of the option, or sometimes position wise we call it as the long position in the call option. Whosoever has taken the option, whosoever has given this call option to this party, we call them as the seller of the option, or we call them as writer of the option, or we even call that particular position as the short position itself. Similarly, in case of put also, we have the same role. The holder or the buyer of the put option, he will have the right to sell, and the seller or the short of the put option is acting as per the buyer of the put itself. So probably if I try to make a grid kind of thing here: buy and sell, call and put. Probably instead of buy and sell, I could have put it as long and short. So if I look at a grid here, a long call position, it's right to buy an asset in future. And if at all this person wants to buy the short call position, it is mandatory to sell. If at all the call wants to buy, a long call wants to buy, short call position has to sell it. Similarly, when I take up a long put position, we are talking of right to sell the asset in future. And when this party wants to decided to sell it, the for a short put position, it is mandatory to buy that asset. So the short positions in the option, they are mandatory to they have the mandate, or they have the obligation to act as per the decision of the long positions of the options, whether it is call or put. The date on which the buying or selling, or the decision of the long position can take place, is what we call as the exercise date, or the expiry date, or the maturity date. These are the various terms associated with it. The price at which the buying or selling can happen, or the option to buy or sell takes place, is what we generally call as either the exercise price or the strike price. The two common names associated with this price: the exercise price or the strike price. Now, one more dimension with respect to the types of option is generally the options can be American or European. So this is more to do with the expiration date. If the party if the party who has taken the option can really decide about going ahead with the option or expiring it any time before the date. Let's say the expiration date is 20th August 2014, and today it is 1st August 2014. The party who has entered into this American option can decide on any of these days from 1st August to 20th August in terms of when he can exercise the option or when he can expire the option. That is what is the characteristic associated with an American option. But when we are talking of European option, the exercise can happen only on the expiration date. Anywhere before the expiration date, all these days from 1st August to 20th August, even though there is a possibility of exercising the option, this position cannot exercise that option. That is what is the behavior of European option, right? So that is one categorization of the options, looking at it as European versus American. Now let's spend some time in terms of understanding what happens as a part of the call option. So when we talk about a call option, from a buyer or from a long position, I always talk in terms of position. From a long position, he has the right to buy the asset in future at a fixed price. Right? He has a right to buy the asset in future at a fixed price. So because he is having that particular right, he will typically pay a premium. To get that right, he is paying a premium upfront to the party who is giving the right, to the seller of the option, to the writer of the option, to the short position of the option. He is paying a premium upfront to get that particular right. So it can simply go like, Okay, I'm buying a call option. Let's say Mr. X, he has bought or he has taken a long position in a call option. Let's say on a stock, saying that he'll be buying 100 shares of that particular stock after 1 month at, let's say, $100 per share. Now, if he wants, he can pay $100 and purchase it after 1 month, and if he is not interested, he can leave it off. So just to get that right, he is paying today, on the day he is entering into the contract, let's say $3 per share. He is paying as a premium. So today, by just paying a $3 per share, or probably overall $300, he is taking a right. If he wants, he can buy the share at $100 after 1 month, and if he doesn't want, he can just lose out his $300 and he can very well get out of the contract. So that is what we are talking of as a part of the call option here. By paying initially a $3 per share, the person who has taken a call option, he is purchasing the right to decide after 1 month whether he wants to buy the share at $100 or he does not want. So generally he will exercise the option only when the market price is greater than the 100. Here the $100 is what we call as the strike price or the exercise price. So when the market price is greater than the strike price only, he will be exercising it. So if the market price goes to 105 after 1 month, he has the option to buy it at 100. So he is going to buy it at 100, make a profit